we will review the income statement focus for using the allowance method to account for receivables. And this is, the income statement focus is the percentage of sales method, is a one-step approach. Now, when you're handling bad debt, you can use the direct write-off method or the allowance method. Now, technically, the direct method is not GAAP. It does not follow the matching principle, but it is allowed if the amount is not material, and this is a company that rarely deals with bad debt. But the allowance method is required by GAAP unless you have that exception. That exception often is a cost-benefit constraint decision. The income statement approach, this is where you're looking at the percentage of sales. The balance sheet approach, two different ways, the percentage of total receivables or the aging of receivables. We're going to focus on the income statement approach. It is an estimate. It is best from matching standpoint, but it tends to be the hardest to estimate exactly. It is an end-of-the-year adjusting journal entry. So it's a one-step calculation, and we're going to use a T account, the allowance for uncollectibles. That is your contra asset to accounts receivable. So if it's a contra asset, the normal balance will be a credit, and it is a permanent balance sheet account if you are using this. Beginning balance, write-offs will decrease the allowance account. When you record bad debt expense at the end of the year, that will increase the allowance account. And then, of course, you'll have an ending balance to the balance sheet. But that bad debt expense, that's that middle number. It's a one-step calculation. Take your sales, multiply it by the percentage you're using. That's your bad debt expense, and you're done. So let's say your beginning balance is $215, credit sales $1.4 million, cash collections $1.35 million, write-offs for the year were $25,000, and what is your ending balance? Well, we'll see how we plug these into the T accounts to create your journal entries. And then, of course, that allowance account is a permanent account. Bad debt expense is going to be based on 2% of credit sales. So here's where you begin. Plug your beginning numbers into your T accounts. Next, look at your credit sales. Where would this go? It would increase accounts receivable. Accounts receivable sales, cost of goods sold, merchandise inventory. Cash collections are given. This will decrease your accounts receivable. Look at your write-offs. How is this going to affect your accounts? Well, you're not recording bad debt when you write it off. That you record bad debt when you put money into your allowance account at the end of the year. During the year when you write things off, you decrease accounts receivable and you decrease your allowance. There's your debit and your credit. So what is the correct journal entry for writing something off? Is it allowance for uncollectibles and accounts receivable or bad debt expense and accounts receivable? I think I just gave it to you. The one below, that would be using the direct write-off method. Using the allowance method, it's the journal entry for example A. This is where you want to focus. Bad debt expense is the end of the year adjusting journal entry if you're using the allowance method. You're not recording any bad debt expense throughout the year. Okay, now we look at what is bad debt expense. I'm taking $1.4 million, multiply it by 2% credit sales. I want that bad debt expense to be $28,000, so it's a one step and you're done. But still you have to determine what your ending balances are, because the $28,000 is going on the income statement. The $240 less the $29,500 is going on the balance sheet. But to calculate bad debt expense, it's a one step and you're done. And this is how your current assets should be shown for your net realizable value of your accounts receivable.